that I would argue something new has entered the equation in the last number of years, and that's the emergence of another world currency which has some world money capacities, and that's the euro. By the way, quick pause. Some people think that when I make an argument like I'm about to make, this means I'm arguing that the dollar regime is over. I make no such claim. I do not believe the dollar regime is over, as I'll explain in a moment. But I do believe that the dollar regime is being eroded, it is being weakened in terms of its capacity to completely hegemonize and dominate the world market, and that the emergence of the euro means that we will probably move into a bipolar regime for world money over the coming decade or so. And here I will send around, I'm not going to send around the first set of tables that I brought, because actually Chris had most of them in a different, in chart form, but I will send around something about the distribution of foreign assets. No, hang on, that's the wrong one. Here, yeah, send that one around. Scott. I may not have brought enough copies for people, but I'll say a little bit about this in a moment. But I think the evidence suggests that, in fact, private capital and now increasingly central banks are starting to diversify assets. That is to say that there is a systematic but slow erosion in the position of the dollar as an international reserve asset, and there is a systematic, albeit equally gradual, rise in the euro as an international reserve asset. And I'll refer to the data on the chart on table 2, which essentially shows that at the time the euro gets introduced in 1999, just under 18% of world assets are being held in euros and 71% in dollars. That by 2006, the last year for which we have obviously any comprehensive data, just under 26%, up from about 18, are being held in euros, and just under 65%, down from 71%, are being held in dollars. Let me give a few other pieces of data. On international bond markets, euro-denominated debt now significantly exceeds dollar-denominated debt. In other words, those who are buying bonds on the world market are buying more denominated in euros than in dollars. Euro-denominated debt at the end of 2006 was 49%. Dollar-denominated debt was 37%. As a means of payment for cross-border transactions, the euro is now 39% of all cross-border transactions in the world, US dollar 43%. There are a number of things which are happening in the EU which I think will increase this. In particular, there's a new initiative called the Market in Financial Instruments Directive, which is going to much more thoroughly integrate euro credit and derivatives markets, and making it more liquid, and therefore I think that trend will continue. And if you look at the basket of currencies to which major holders like China, Russia, and a whole number of the OPEC states are now tying their currencies, they are systematically diversifying. That is to say, those who are solely dollar are now dollar-euro, and the euro holdings are rising proportionately while the dollar holdings decline. This is not an argument for the imminent collapse of the dollar or the dollar regime. I'm not making any such claim. What I'm suggesting is that in the 1970s and 80s, when the dollar became a problem for other sections of global capital, they had no alternative as viable as the euro, as a store of value and as an international reserve asset. The euro didn't exist till 1999. The appearance of the euro, based upon an economy of roughly equal size, as the US changes that. And as I say, it's not an argument that we're now about to move automatically to a dollar standard, a euro standard. But if you look at table 1 that I circulated there, what you'll see is something interesting, I think, about the so-called sterling standard. That is to say, it was never as overwhelming as we often imagine it to be. The dollar, as you'll notice from my table, was 84.5% of all reserve assets in 1973. It's 20% lower than that today. But sterling's peak, 1899, was 64%. and you had fairly significant degree of diversification. Sterling by 1913 was 48%. In other words, it is not the case that regimes of world money have to be winner take all. That's a myth which is built into a number of the histories about world money. In fact, world money regimes have been more diversified in the past than was the dollar standard regime at its height, and I believe we are moving into a period where it is becoming increasingly diversified. Deutsche Bank put out a report last year where they argue that by 2010, in other words, 2 years from now, the euro will be somewhere between 30 and 40% of all international reserves. I don't know if they're right, but certainly over 30% seems to me entirely plausible. And that will be largely, again, at the expense of the dollar. Now, what does this mean? It does not mean the end of U.S. empire. It does, however, mean some meaningful erosion of a whole number of the economic capacities that dollar seigniorage, the ability just to issue dollars and to have them taken as gold, as world money, has had for the U.S. I think it does impose some real constraints on the capacity, for example, of the U.S. to fund endless numbers of wars all over the place and in this situation. I think we're talking about what is effectively a more fractured imperial order than we are accustomed to. That is to say, that there will be more than one center of world money capable of exercising significant kinds of economic powers on the world scale than has been the case. I also believe, because of course any of you who've reflected on Table 1 that I've sent around will also say to yourself, yeah, but look, none of those rivals, the franc or the mark, eventually became the new world money. Absolutely true. The new world money came from the U.S. in the end, and not from any of the European competitors of the pound. I think that a huge amount will be determined in the next quarter century by where China goes in all of this. That is to say, China is clearly diversifying its assets right now. It is, in a whole variety of ways, moving in a much more multiple scale set of relationships to other major economic blocs in the world. And I won't predict what China will do, except to say that it seems to me that the dollar's position is less hegemonic today and less hegemonic in the coming period than it has been. That, I believe, is one of those few Marxist predictions I'm prepared to make, because Marxists are notorious for bad predictions. I think that's a safe prediction. That is to say that the movement of international reserves away from the dollar will continue. This is where I would disagree with Scott, whose presentation I found really, really interesting. It would be cyclical, I would argue, were there no euro. In the context of the euro, I think it's secular and not just cyclical. That would be my argument in terms of these movements. And so, as I say, to conclude, I think we're looking at a more fractured imperial order, and one in which an erosion, not a disappearance or collapse, of the status of the U.S. dollar also imposes some significant constraints on U.S. empire.
Great.